This may be a surprise to a few of you, but the three U.S. banks that collapsed this year, First Republic, Silicon Valley Bank, and Signature Bank of New York, had more combined assets under management than all 25 federally insured lenders that failed back in 2008. You remember that, right? The failed lenders that sparked the Great Recession. Yes, those three banks that collapsed this year had more asset value than the 25 FDIC insured lenders that failed back in 2008. Think about that for a second. And the U.S. banking sector was dealt another blow when the FDIC stepped in to seize control of First Republic, marking the second largest bank failure in U.S. history by assets, and then it auctioned it off, sold it off to J.P. Chase. How much money did First Republic hold? Well, as of the end of last year, First Republic had approximately $213 billion in assets under management. SVB had $209 billion of assets under management as of last December 31st, while Signature Bank had roughly $110 billion under its control. And when combined, the three failed banks held an astounding $532 billion in total assets. Meanwhile, the 25 banks with FDIC insurance that failed back in 2008, including one-time industry giant Washington Mutual, had $526 billion in combined assets at their points of collapse. And that's when adjusted for inflation. And this math is brought to you by a recent article from the New York Times. Now, to be fair, the sum does not include failed investment banks such as Lehman Brothers and Bear Stearns. Still, it provides an indication of just how brutal a hit the U.S. banking sector this year took, as large regional lenders face pressures from a rapid rise in interest rates. Now, First Republic coming under immense pressure this year following the earlier collapses of Silicon Valley Bank and Signature Bank, which prompted a flurry of deposit outflows. Simply put, worried customers pulled their money out of those regional banks. And J.P. Chase acquired First Republic overnight Sunday into Monday in a government-led deal, following weeks of speculation about whether the lender would be able to survive. Remember this as well. First Republic failed despite an earlier rescue effort that saw the nation's largest banks, including J.P. Chase, pour in $30 billion in a bid to stabilize the lender. As part of the acquisition deal, J.P. Chase assumed control of approximately $173 billion of loans and approximately $30 billion of securities that were held by First Republic. And here's some sour news. The FDIC said its seizure of First Republic prior to the sale would result in roughly $13 billion in a hit to its deposit insurance fund, the DIF, which backstops deposits at insured banks all across the nation. And that's where we stand right now. First Republic, Silicon Valley Bank, and Signature Bank of New York currently rank as the second, third, and fourth largest bank failures in U.S. history. Washington Mutual still ranks first with $307 billion in assets under management when it failed back in 2008. But one has to wonder what's next for the U.S. financial sector. Three of the four largest U.S. bank failures in history have come in quick succession since March. And investors are wondering, will more banks collapse or is the worst over? What does the White House think? You know what? We'll end it right there with President Biden addressing the sale of First Republic Bank in front of the White House.
Regulators have taken action to facilitate the sale of First Republic Bank and ensure that all depositors are protected and the taxpayers are not on the hook. These actions are going to make sure that the banking system is safe and sound, and that includes protecting small businesses across the country who need to make payroll for workers and their small businesses. And so let me be very clear. While depositors are being protected, shareholders are losing their investments. And critically, taxpayers are not the ones that are on the hook, as I said earlier. Now, going forward, I've called on Congress to give regulators the tools to hold bank executives accountable, and I've called on regulators to strengthen regulations and supervision of large and regional banks.
Share your thoughts in the comments below. Subscribe to Modern Wall Street for all of your video updates. And for Modern Wall Street, I'm James Sweeney.